In this video, I'm gonna give you everything that you need to know in order to make an educated decision about FHA loans. Let's dive in. FHA loans are government-backed loans that are insured by the Federal Housing Administration, and they're designed specifically to help out individuals that might have lower credit scores or smaller down payment. So it's a very flexible mortgage program. That's literally designed to make it easier to become a homeowner. All right, first things first, down payment. Down payment is probably the largest hurdle when it comes to basically buying a house, saving up for that down payment. Well, with the FHA loan, it makes that challenge a lot easier because you only have to come up with a 3.5% down payment. You don't need 20% down. You don't need some big giant down payment with FHA. 3.5% is as good as 20% when it comes to an FHA loan. Now, I do have to point out that if you have a FICO score that's below 580 and above 500, then you're gonna have to come up with 10% down. You're considered a higher risk. You'll be doing a manually underwritten loan most likely. No big deal, we do those all the time, but you are gonna have to put a little bit more skin in the game because of the risk. But if you're at 580 or above, 3.5% down all day long. All right, let's talk credit scores. Because when it comes to credit, FHA is definitely the most lenient of all available financing options. And like I just mentioned, you can literally get financing with a 500 FICO score. Whereas if you're looking at like Fannie Mae, Freddie Mac, they want to see a 620 FICO score to bare minimum. And FHA is much more flexible when it comes to your credit history. Maybe you had a bankruptcy. Maybe you had some late payments. Maybe you don't have perfect credit. Well, FHA doesn't care as much as your conventional financing. They're not going to beat you up over your past as much as Fannie Mae or Freddie Mac will. So between the low down payment and the low FICO score that FHA allows, it makes the program the easiest to qualify for out of all available financing. Now, when it comes to FHA loans, there's some important nuances that you need to know about that'll help you make an educated home buying decision. So when you're weighing out the pros and cons of an FHA loan versus other types of financing, one of the things that you're going to need to evaluate is the cost of an FHA loan. Something that's different about FHA that is not applicable in the other types of loans is that FHA is going to actually charge you a fee. They're going to add it to what you owe. You get to finance this fee, but they're going to charge you 1.75% of whatever you borrow as a upfront mortgage insurance fee. Basically, it's how they fund the program against default because all these loans, like I mentioned, are insured by the Federal Housing Administration. And so you're basically, if you're going to participate in the program, you're going to pay into it as well. Now, speaking of mortgage insurance, the other thing with FHA loans is that you will have a monthly mortgage insurance premium as part of your monthly payment. It's $55 for every $100,000 that you borrow, and that will be for the life of the loan, which is different from like if you're doing a conventional loan. Maybe you should check out my recent video about how to remove PMI. That wasn't on FHA loans. I was talking conventional financing because on FHA, you're stuck with the monthly mortgage insurance for the life of the loan. Remember that the life of the loan is not a life sentence. You can refinance when terms become more favorable and lower your mortgage insurance or completely eliminate it, which is typically what most people do when they're refinancing out of their purchase loan. Now, just like all loans, there's going to be loan limits based off of where you are buying. So if the home is located in Sacramento County, the loan limit is going to be different than Suffolk County in Virginia or whatever the case. So it's important when evaluating whether or not a FHA loan even makes sense to ensure that the county that you're going to be buying the property in allows for an FHA loan limit in the amount that you need. For instance, if you need $600,000 loan and the loan limit's $500, well, that's going to be a problem, right? So you got to look at that up front, which, by the way, this is where having a really great mortgage professional on your side, shameless plug, New Way Mortgage, on your side to help you figure this stuff out so that you don't need to actually become a mortgage pro to get your own loan done. All right, so let's switch gears and talk about property requirements. This is one of the sticky points when it comes to submitting your offer to the seller and why some sellers can be apprehensive about accepting an FHA offer because of the appraisal requirements. FHA is gonna kind of step it up a notch from what Fannie Mae and Freddie Mac want, and they really wanna make sure that the home that you're purchasing meets specific health, safety, and structural standards. So basically the appraiser is gonna dig in a little bit deeper than they normally would. For example, if you're buying a house that maybe has an attic or a crawl space, they're actually gonna pop their head up in the attic and take a look-see real quick. They're not gonna climb around. They're not a home inspector, but they are gonna visually take a look, and if they see anything that looks off, they're gonna bring it up in the report. And since it's more likely that potential repairs needed can come up in an FHA appraisal versus a conventional appraisal, some appraisers who, have skeletons in the proverbial closet, they don't want to accept those offers. So this is going to be something where when you're looking for homes, sometimes you'll see where it's like no FHA. Well, that's because there's probably problems with the property and they don't want an FHA appraiser poking around and finding things wrong with the property. Now, when it comes to the types of FHA financing available, there's basically 4 loan types that exist. There's the 203B program, which is basically the loan that I'm talking to you about right now to help you purchase a house. There's a 203K program, and this is something that we get questions about all the time, and honestly, it's more of a conversation than something that most people actually take action with. And what I'm talking about is the 203K loan, and that's a rehabilitation loan. Basically, you're buying a property that needs a massive remodel or maybe a minor remodel. Usually it's a lot of work though, and you utilize an FHA loan to finance the cost of the rehab, and it gets built into the deal. It's a lot more complicated. You got more cooks in the kitchen, you got contractors, you also have more confusion in the process, which makes it harder for those offers to get accepted by sellers. So we just don't see it as much, but it is available. Now you've got the HECM mortgage, which is basically a reverse mortgage. If you're 62 years or older, you can use FHA for reverse mortgages. And then there is the energy efficient mortgage. And that's basically an add-on to all the other types of loans that I was just talking about, where you can finance energy efficiency improvements on the property. It's very specific what you're allowed to do, but an EEM allows you to basically, maybe you're putting in new windows, something like that, and you get to build it into your financing. Now, when it comes to occupancy, FHA is for primary residences only. You don't get to go buy rental properties. You don't get to buy your vacation home in Vail. You're using FHA for your primary resident. The only hack around that is, let's say that you're going to buy a duplex or a 3-plex or a 4-plex. So you can buy a 2 through 4 unit property, but here's the thing. You have to live in one of the units, making it your primary residence. So if you're young, if you're flexible, I would highly recommend diving onto that house hack. Buy a multi-unit property, live in one of the units for a year or two, let your renters cover your mortgage payment, and then at a certain point, go find your next house and rent out that unit. And you will have literally used an FHA loan to buy your future rental property. Now for FHA loans, you have to go through an FHA approved lender. Not all lenders do FHA loans, but not all lenders are alike. Once again, shameless plug, you need an FHA loan, we got you covered at New Way Mortgage. Contact information is in the description below. Reach out to us. We'd love to help you. So one of the nice things about FHA loans is that once you've got an FHA loan, it's very, very easy to refinance that FHA loan. They call it a streamline. In fact, there's no credit, there's no appraisal, there's no income checks. Basically, if the rates are lower and it makes sense financially for you to do it, you can streamline down into that lower rate, and the refinance process is extremely easy compared to the normal process, which is basically you're getting a brand new loan. You're getting a new appraisal, submitting new income documentation, new credit report, new underwriting. With a streamline, you've already got the loan. You don't have to requalify for it. You just have to be able to save a certain amount of money in order for them to approve it. Now, one of the really nice things about FHA loans is when it comes to seller concession. And to be quite honest, with the new ruling from the National Association of Realtors, with how buyer's agents are going to get paid going forward, this is actually going to make FHA potentially a more viable option for home buyers. Why? Because FHA allows you to have up to 6% in seller credits with a minimal down payment, whereas on Fannie Mae and Freddie Mac loans, in order to get that that 6%, you got to put 10% or more down. Otherwise, you're capped at 3% in seller concessions. So if your buyer's agent commission is 3% and you're trying to get the seller to cover other closing costs, well, you just tapped out if you're on a Fannie Mae less than 10% down. But on FHA, you can go all the way to 6%. Now, like all types of financing, it's important for you to consider the long-term costs and evaluate what makes the most sense for you. Like I said, FHA is very flexible, but it can be a little bit more expensive when it comes to that upfront mortgage insurance and having monthly mortgage insurance for the life of the loan. But that's the price that you pay for having a lower credit score or lower down payment. So you got to kind of weigh those options out against your other financing options to ultimately figure out what's the best deal for you. And when it comes to alternatives, you got Fannie Mae and Freddie Mac. We've talked about that a little bit. You also have, in rural communities, USDA loans. Those are really great loans. I've got a ton of videos about that on the channel. And then for our veterans like myself, the VA loan, the Cadillac of financing, if that's an option, I'd take that any day over an FHA loan. But if you're not a veteran, if you're not moving into the country somewhere, if you're buying basically in the suburbs or the city or something like that, and you have lower credit, you have a lower down payment, an FHA loan is definitely going to be one that you're going to want to consider when looking at all your available options. I hope you got value out of this video. Like I said, I was going to give you enough information just to make you dangerous, but you don't need to be the expert. Let us be the expert for you. If you got questions about FHA loans or any type of financing, reach out to me. My contact information's below. I'd love to help you out. And if you haven't already, do me a huge favor, tap that like button, make sure to subscribe, and I'll see you on the next video.